We continue now our discussion on journal entries. We are now on January 20. On January 20, the company rendered services on account for 40,000. So of course, when we talk about rendering of services, then it is clear that we have to recognize service income again because service is already rendered and service income is an income account. So of course, the other part of the transaction is this one. The service was rendered on account, meaning on credit. The client therefore did not pay cash, and therefore the company did not receive any cash from this transaction at the moment. But what the company has here is the right to collect, because obviously this 40,000 is collectible from the client, and the right to collect is accounted for as accounts receivable. So this is the opposite of accounts payable, because now it is the company who has something to collect, and unlike in the previous wherein it is the company who is obliged to pay. So again, like accounts payable, if the company here has the right to collect and the client also issued a promissory note, a written promissory note, then what we should have used instead is notes receivable. But since it is only a verbal promise to pay, then the appropriate account title is accounts receivable. So of course, again, we have accounts receivable as an asset account and service income an income account. Our transaction therefore is an accountable event, and the effects are, of course, we increase accounts receivable because previously there was no accounts receivable, but now that we have this transaction, we have the right to collect, and therefore it increased from 0 to 40. Income is to be recognized, and therefore income should increase also by the same amount. And again, remember, income is part of owner's equity account. Okay, so if we present this transaction in the table, we have assets increased by 40 because of the increase in accounts receivable, and owner's equity increased by the same amount because of the increase in service income. Okay, liabilities is not affected, so 40 equals 0 plus 40, and again the equality of the accounting equation is always maintained. If we present this in an expanded equation, we have assets increased by 40 because of the increase in accounts receivable, and income increased also by the same amount because of the increase in service income. This increase in service income, when accounted for in the entirety of the owner's equity, is also an increase in owner's equity, because again, income has the effect of increasing owner's equity, unlike expense. So for the transaction analysis, applying the rules on normal balances, accounts receivable therefore should be debited because we need to increase it. Service income should be credited because it increased also. And summarizing that, we have accounts receivable debited for 40 and service income credited for the same amount. If we convert that to an entry, we have debit to accounts receivable and credit going to service income, and the amounts would be the same, 40,000. Our explanation can be as simple as service rendered on account. That is our journal entry for transaction on January 20.